All right, let's unpack this. Have you ever stared at a tax form and felt like you needed a secret decoder ring just to understand the first line?
Happens all the time.
Well, today we're pulling back the curtain on one specific form that can often feel like a true puzzle. Form 8960, all about the net investment income tax.
Yes, the NIIT.
It's that 3.8% tax that sometimes seems to sneak up on people. And trust me, for a lot of informed investors like you, understanding it isn't just about compliance. It's really about smart financial strategy.
That's spot on.
Yeah.
For many, especially those with, significant investment income, this tax can be a critical piece of their overall financial picture.
Right.
Our mission today is to demystify it, helping you understand not just what income gets counted or excluded, but why these distinctions matter for your bottom line.
Exactly.
We're going to walk through this form, highlighting the key strategies and, well, opportunities you might have to optimize your tax position and maybe save some serious money.
The basics. What is the net investment income tax, NIIT, and who does it affect?
So let's dive right into the fundamentals then. What exactly is the core purpose of Form 8960, and what is this net investment income tax really?
Okay, so at its heart, Form 8960 is basically the IRS's way of figuring out how much of the net investment income tax, or NIT, you owe.
NIT, right.
Now, it's really important to understand this isn't just another layer of your regular income tax. It's a separate 3.8% tax that gets added on to your other income taxes.
Added on. Okay.
And it specifically applies to certain types of investment income for higher income individuals, estates, and trusts. You only need to attach this form to your tax return if your modified adjusted gross income, which we'll probably just call NGI from now on.
Yeah, gee, I got it.
It's above a certain threshold, and you actually have net investment income. It's kind of a tax designed to ensure that those with substantial investment earnings contribute a little more.
And right out of the gate, we're hitting acronyms. MGI, NIIT. Let's make sure we're all on the same page. When we talk about modified adjusted gross income, or MBI, what exactly are we referring to? Because it's not just the standard adjusted gross income from your Form 1040, is it?
Exactly. It's not always a straightforward copy-paste from your 1040. For most people, yeah, your MGI for NIT purposes will be the same as your adjusted gross income from your Form 1040 or 1040SR.
Okay.
However, there are specific situations where it gets a little more nuanced, particularly for folks with, say, a global financial footprint.
Like foreign income.
Precisely. If you're living and working abroad and using the foreign earned income exclusion, for example, or if you have complex foreign investments like controlled foreign corporations, CFCs, or passive foreign investment companies, PFICs.
The alphabet soup of international tax.
You got it. In those cases, your AGI will need specific adjustments just for this tax. And these tweaks can surprisingly shift whether you're even subject to the NIT at all. Oh, yeah. Understanding how your personal NGI is calculated is truly your first gate to understanding your NIT exposure.
Okay, so NGI is step one, figuring out if you're even in the NIT ballpark. Now let's talk about the other half of the equation, net investment income, or NII. This feels like the core of what actually gets taxed here.
This definition is absolutely central. It really is, because it's where many of the most impactful tax planning and, optimization opportunities lie.
Makes sense.
Generally, net investment income includes your typical investment earnings, gross income from interest, dividends, annuities, royalties, and rents.
The usual stuff.
Right. But here's the critical money-saving nuance. These types of income are excluded from NIT if they are derived from the ordinary course of a trade or business that isn't considered a passive activity for you.
The active versus passive distinction.
Exactly. Or if it isn't a business that primarily trades in financial instruments or commodities. So if, for example, your interest income comes directly from an active, non-passive business where you materially participate.
Like running your own shop.
Yeah, precisely. That interest income often won't be subject to NIT. This is a vital distinction for business owners. Beyond those core categories, NII also includes other gross income from a trade or business that is a passive activity for you, or specifically, a trade or business that focuses on trading financial instruments or commodities.
So passive business income is usually caught.
Generally, yes. This is an important clarification because it ensures that passive business income that might otherwise seem unrelated to investing can still be caught by the NIT.
Okay.
And of course, NII also includes any net gain from the sale or disposition of property, unless that property was held in an active, non-passive trade or business that isn't a trading business.
So selling business assets might be excluded.
Potentially, yes, if it meets that active, non-trading business criteria. Finally, all these gross income items are reduced by deductions that are directly tied or properly allocable to them.
Got it.
Understanding these subtle distinctions is your first powerful step in not just understanding NIIT, but actively planning to reduce it.
That's a crucial point, because it really clarifies that not all income is treated equally. This brings us directly to a powerful lever for tax planning. Knowing what income is specifically excluded from NIIT. This is where your planning can get really interesting.
Absolutely. Knowing what's not included can provide significant opportunities to reduce your NIIT exposure. Common examples of generally excluded income include your wages, unemployment compensation.
Standard earned income stuff.
Right. Alaska Permanent Fund dividends, alimony, Social Security benefits, and tax-exempt interest income, like from muni bonds.
Okay.
But for an informed investor like you, two major exclusions really stand out and can be game changers. First, income from certain qualified retirement plan distributions is generally excluded.
Oh, that's huge.
It is. This means if you're drawing income from your 401ks, IRAs, Roth IRAs, or other qualified plans, that income is typically safe from the NIIT.
So retirement accounts are mostly protected.
Generally, yes. This is a huge relief for many retirees, safeguarding their primary retirement income streams.
That's great news. What's the second big one?
The second key exclusion is income that's already subject to self-employment taxes.
Okay, so business income again.
Right. If you're a small business owner, a consultant, or a freelancer paying self-employment tax on your active business income where you're truly materially participating, that income typically won't be hit with the NIIT either.
So it avoids a double hit, kind of.
Exactly. These two categories alone can offer massive tax savings depending on your income profile and how you structure your affairs. It's about ensuring you're not taxed twice on the same income stream.
So it really boils down to how you define and participate in a trade or business. This leads us to a specific definition the IRS uses for this tax, a Section 1411 trade or business. Why is this particular definition so important for our purposes?
It's important because it creates a very specific boundary. A Section 1411 trade or business is defined in one of two ways. Either it's a passive activity for the taxpayer, meaning you don't materially participate.
Like a silent partner, maybe?
Something like that. Or it's a trade or business specifically focused on trading in financial instruments or commodities.
So day traders, for example.
Right. Now, income from a trade or business that isn't a Section 1411 trade or business, in other words, an active, non-passive business where you do materially participate and it's not primarily a trading business, is generally excluded from NIIT.
Okay, that's the key.
Yes. So, if you're actively running a tech startup, a manufacturing company, or a consulting firm where you are fully engaged, the income from that operation is typically not subject to NIIT. This is a major distinction and a powerful advantage over passive investment income.
Now that we've got a handle on the definitions, let's get down to brass tacks. Who exactly has to pay this 3.8% NIIT?
Okay, for U.S. citizens and residents, you'll generally be on the hook if two conditions are met. Your MAGI exceeds an applicable threshold and you have net investment income.
Both have to be true.
Both. And the tax isn't just 3.8% of all your NII, it's calculated as 3.8% of the smaller of two numbers.
Smaller, okay.
Yeah, the smaller of A, the amount your MGI is over that threshold, or B, your actual net investment income. So you're only taxed on the lower of those two figures.
Oh, that's interesting. It caps the tax base.
Exactly. This is your first crucial check to see if the NIIT even applies to you, and if so, how much is potentially subject to it. The applicable threshold amounts are really the first line of defense to know if you're in the NIT zone. For those married filing jointly or a qualifying surviving spouse, the threshold is $250,000 NIGI.
$250,000, okay.
For married filing separately, it's $125,000, much lower.
Half, yeah.
And for single filers or heads of household, it's $200,000.
Okay, 250, 125, 200. Got it.
Think of these as the income checkpoints. If your NGI is below these figures, you generally don't need to worry about the NIIT at all.
That simplifies it for most, but what about individuals with international ties, non-residents, or those with dual status? Does this tax apply to them? My gut tells me this gets even trickier.
You're absolutely right. It adds layers of complexity. Generally, the NIIT doesn't apply to non-resident alien or NRA individuals.
Okay, so NRAs are generally out.
Generally. However, the situation changes if you're a U.S. citizen or resident married to an NRA. By default, for NIT purposes, you'd typically be treated as married filing separately.
Which means the lower $125,000 threshold. Ouch.
Right. But here's a significant planning opportunity. You can choose to make an election to file jointly with your NRA spouse for regular income tax purposes. And critically, you can also elect to apply that joint return election for NIIT purposes.
Ah, so you can choose the joint status for NIIT too.
Yes, if you do this, you get to use the higher $250,000 married filing jointly threshold for the NIT calculation.
That can be a huge difference.
It can be a substantial tax-saving move. It potentially lowers your effective NIIT exposure as it allows more of your income to escape the tax. These international situations truly require careful attention to these filing status elections. Sections 6C113, G, or H are the relevant ones there. Now, for those who are dual status individuals, meaning you are a U.S. resident for part of the year and an NRA for the other part, you're only subject to the NIT for the portion of the year you were a U.S. resident.
Okay, only the resident part.
Right. What's beneficial here is that your NIT threshold amount, whether it's $200,000 or $250,000, depending on your status, is not reduced or prorated for that partial year.
Oh, you get the full threshold even for part of a year.
You do. So you get the full benefit of the higher threshold, which is quite helpful for managing your tax liability during a transition year.
Beyond individuals, how does the NIIT impact estates and trusts? I imagine they have their own specific set of rules.
Indeed, they do. For domestic estates and trusts, the NIIT apprise if they have undistributed net investment income and their adjusted gross income, or AGI, exceeds the very low highest tax bracket threshold for that specific year.
Very low. How low are we talking?
We're talking much, much lower than for individuals. It changes slightly each year with inflation, but it's usually only a few $1,000s, not hundreds of thousands.
Wow. Okay. So lots of trusts could easily hit that AGI threshold.
Exactly. And because the thresholds for estates and trusts are so much lower, many trusts can easily find themselves subject to NIIT if they have undistributed investment income. The tax is 3.8% of the lesser of their undistributed NII, or the amount their AGI exceeds that low threshold.
This sounds like a critical aha moment for anyone involved in estate planning or managing trusts. It really seems like the type of trust you have can be a game changer for NIT. What are the key exceptions or trust structures that can help avoid this tax?
Absolutely. Understanding these exceptions is a truly significant tax-saving strategy for estates and trusts. Many trusts are structured in ways that directly exempt them from NIT. For example, charitable trusts, like private foundations, maybe, and qualified retirement plan trusts are not subject to it.
Okay. Charitable and retirement plan trusts are out.
Right. The same goes for charitable remainder trusts, CRTs. Crucially, trusts that are classified as grantor trusts are generally exempt.
Why is that?
Because for tax purposes, the income in a grantor trust is treated as belonging directly to the grantor, the person who set it up, not the trust itself. So the NIT liability, if any, falls on the grantor's individual return.
Ah, it passes through.
Exactly. Other specific exceptions include electing Alaska Native Settlement Funds and perpetual care or cemetery trusts. Even certain entities that, despite their name, are not classified as trusts for federal income tax purposes, like real estate investment trusts, REITs, and common trust funds, are not directly subject to the NII at the entity level, though distributions might be NII for the recipient.
So the structure is everything here.
It really can be. Choosing the right trust structure can significantly impact your NIIT liability, offering a powerful way to manage investment income for future generations. There are also some special calculation rules for very unique types of trusts. For example, qualified funeral trusts, or QFTs, calculate NIIT on a per-beneficiary contract basis, which is quite specific.
Okay.
Electing small business trusts, ESBTs, which can hold S-Corp stock, have a multi-step process to combine their S-portion and non-S-portion income and AGI to determine NIT.
Sounds complicated.
It is. My advice here: if you're dealing with one of these highly specialized trusts, this is where you definitely want to engage a tax professional because the calculations are very nuanced. And just as a practical tip for those receiving income from abroad, if you're a U.S. person who receives an income distribution from a foreign estate or foreign trust, you generally must include that distribution in your net investment income calculation if it's already part of your AGI for regular income tax purposes.
Okay, so foreign trust distributions are usually included.
Usually. However, here's a key exclusion. You typically do not need to include any distributions of accumulated income that you receive from a foreign trust if that accumulated income has already been taxed at the trust level or is specifically excluded by other rules.
Ah, avoiding double taxation again.
Exactly. This can be an important distinction for global investors trying to manage their tax burden fairly.
Deconstructing investment income, a line-by-line guide, Part 1 of Form 8960.
All right, now that we've set the stage with who's affected and why, let's pull back the curtain on the form itself. Imagine we're walking through Form 8960 together, page by page, uncovering where your numbers fit in, and more importantly, where you might find those hidden opportunities to lighten your tax load. At the top of Part 1, there are some checkboxes for elections. What are these about?
Yeah, those checkboxes are essentially places to signal certain choices you've made that impact your NIT calculation. You'll see boxes for those elections we mentioned earlier, like Section 6013G or H, that allow a U.S. citizen or resident to file jointly with a non-resident alien spouse for NIT purposes, unlocking that higher threshold.
Right, the joint filing election.
And there's also a checkbox for a specific election related to controlled foreign corporations, CFCs, or qualified electing funds, QEFs, which is Section 1.141110G. We'll dive into that a bit more later.
Okay.
Making these elections often requires attaching a specific statement to your return, explaining the details so it's not just a simple check mark, it's a formal declaration.
Got it. Let's jump into the actual lines then. Line 1 is for taxable interest. What should our listeners be putting here, and are there any adjustments that can effectively reduce the amount subject to NIT?
Okay, line 1. For this, you'll generally include all taxable interest you reported on your main tax form, like your Form 1040 or 1040SR. Simple enough start. Now, for the smart part, the NIT reduction opportunities. If you earn interest income in the ordinary course of a non-NIT trade or business, remember that's an active business where you materially participate, and it's not a trading business, that interest income is excluded.
Excluded how? Where does that adjustment happen?
You'll make this adjustment later down on line 7 as a negative modification. It effectively removes that active business interest from your NIT calculation.
Okay, so line 1 includes it initially. Line 7 takes it out if it qualifies.
Precisely. So if your active business loans money as part of its operations and earns interest, that interest is likely safe from NIT. This is a key distinction that can shield your active business interest income. Also, something called self-charged interest received from a non-passive partnership or S-corporation activity where you materially participate can also be adjusted out on line 7, preventing that income from being hit by NIT.
Self-charged interest, basically interest you pay yourself via your business.
Kind of, yeah. It's interest received on a loan you made to your own partnership or S-corp where you're active. The rules prevent you from having NIT income when the corresponding interest deduction might not fully offset it due to other limitations.
Okay, interesting nuance. So if interest income is one pillar, dividends are often another. Let's shift our focus to line 2, covering ordinary dividends. What goes here, and what are the strategic ways to adjust it for NIT purposes?
Line 2 includes the ordinary dividends you report on your main tax form. Again, pretty straightforward starting point.
Okay.
For adjustments, if line 2 includes dividends you receive from employer securities held in an employee stock ownership plan, an ESOP, that are deductible by the employer under Section 404K.
Specific ESOP dividends?
Right. Or if it includes Alaska Permanent Fund dividends. Those amounts are considered negative modifications. You'll report them on line 7, just like the business interest, to reduce the amount of dividends subject to NIT.
So line 7 is a key adjustment spot.
It really is. It's about ensuring that certain special types of dividends, often tied to specific employer plans or unique state distributions, don't unnecessarily increase your NIT bill.
Line 3 is for annuities. This seems like it could be a really significant area for retirees. What are the most important exclusions here that can offer major NIT relief?
This is a huge one, and it offers substantial relief for many retirees. For line 3, you'll generally include gross income from most annuities, often identified with code D, in box 7 of your Form 1099-RD.
Code D, okay.
However, here's the critical NIT saving exclusion. Annuities paid from qualified retirement plans are generally not included in net investment income.
We mentioned this earlier, but it's worth repeating.
Absolutely. This means income from your 401k plans, 403A or 403B, annuities, IRAs, Roth IRAs, or 457B plans are typically safe from the NIT.
That covers a lot of retirement income.
It does. For many, their retirement income is primarily from these sources, so this exclusion is an enormous benefit. Safeguarding their primary retirement funds aren't unexpectedly taxed again by the NIT. Understanding the source of your annuity income can make a substantial difference.
Moving on to line 4A, which is quite broad. Income from trades businesses, rental real estate, royalties, partnerships, S-Corp, and trusts. What's initially included here before we start making adjustments?
Yeah, this line serves as a comprehensive starting point. It initially pulls in a wide range of income streams from various tax schedules, like Schedule 1 and Schedule E, where you report rental income, partnership income, S-Corp income, royalties, etc.
So it casts a wide net first.
Exactly. It's really important to remember that this line starts by including both passive and non-passive income. The subsequent lines, particularly 4B, are where you'll make critical adjustments to refine what income truly falls under the NIT umbrella. Think of it as pulling everything in, then carefully sorting it out.
And line 4B is where the significant adjustments for trades and businesses really come into play. This looks like a truly powerful area for NIT reduction. Tell us more about how this works.
Line 4B is indeed a powerful tool, a direct pathway to significantly reducing your NIT. Its core purpose is to exclude income or losses from active businesses that are not those Section 1411 trading businesses.
So taking out the active non-trading stuff.
Precisely. If you have net income or a loss from what's called a Section 162 trade or business, meaning a true active business that isn't passive for you and isn't a financial trading business, you'll use this line to adjust it out.
How does the adjustment work, positive or negative?
You enter net gains or income from these non-NIT businesses as a negative adjustment on line 4B, effectively subtracting them from the total on line 4A. Net losses from these businesses are entered as a positive adjustment, which also reduces your overall NII calculation.
Okay, so income reduces the base, losses add back, reducing the overall NII. Makes sense.
Right. For example, if you materially participate in an active S-Corp and that income is subject to self-employment tax, you would typically remove the net income related to that active business here on line 4B. Royalties derived in the ordinary course of a non-passive active business also get excluded here.
So line 4B is the direct way to shield that active business operating income.
Exactly. It ensures that if your business income is truly from your active efforts and not from passive investing or financial trading, it won't be caught by this tax. This is a crucial area where business owners can strategically manage their NIT exposure.
This line also has special and very important rules for rental income, which is a major area for many investors. What are the key tax planning strategies for real estate professionals looking to minimize their NIT?
This is a vital area for anyone serious about real estate investing. Simply qualifying as a real estate professional, or REP, for the general passive activity loss rules under Section 469 doesn't automatically exclude your rental income from NIT.
Oh, it doesn't. I thought being an REP made it active.
It makes it non-passive for those rules. But for NI, it must also be considered income derived in the ordinary course of a Section 162 trade or business. It's an extra hurdle.
Okay, so REP status alone isn't enough for NI exclusion.
Not automatically. However, there's a fantastic safe harbor for REPs that provides a direct, clear path to NI exclusion if the rental activity rises to the level of a Section 162 trade or business.
A safe harbor. Tell me more.
You qualify for this safe harbor if you participate for more than 500 hours in each rental real estate trade or business activity during the tax year.
500 hours per activity, that's a lot.
It can be. Or there's an alternative test. If you participated for more than 500 hours in the rental real estate trade or business activity in any 5 of the prior 10 tax years, whether or not those years were consecutive.
Ah, the 5 out of 10 year look back.
Right. If you meet the qualifications for this safe harbor and the activity is a Section 162 trade or business, then your rental income and any gain from the disposition of that rental property is explicitly treated as derived in the ordinary course of a trade or business and is not included in your net investment income. You'd adjust it out on line 4B.
That is a golden ticket for serious real estate investors.
It really is. Meeting these hours can effectively shield your significant rental income and gains from property sales from NIT, offering a substantial tax saving. Keep in mind, if you've made an election under the regular tax rules, Regulation Section 1.4699G, to group all your rental activities as one single activity, that grouping can help you meet the 500-hour test more easily for NI2 purposes too, if the grouped activity is a Section 162 trade or business.
That grouping election sounds important then. Are there other special rental income rules that allow for NIT exclusion beyond that REP safe harbor?
Yes, absolutely. There are a couple of other specific situations where rental income might escape NIIT. For instance, rental income that's recharacterized as non-passive under the regular passive activity rules because the property is rented for use in a trade or business in which you materially participate.
Like renting a building you own to your own active company.
Exactly. That's a classic example. In that case, the rental income is treated as derived in a non-Section 1411 trade or business and is not included in NIT. You adjust it out on 4B.
Okay.
Similarly, if your rental activities are properly grouped under the passive activity rules with a trade or business activity in which you materially participate, and the grouped activity itself is a Section 162 trade or business, that group income will also be treated as from a non-passive trade or business and not included in NIT.
So the core idea, again, is active involvement.
Pretty much. If you can genuinely demonstrate your rental activities are truly active and integrated with a core business operation where you put in significant effort, you might significantly reduce your NIT exposure. It's about active involvement in business operations, not just passive ownership collecting rent checks.
And what about those suspended losses from former passive activities? Can those be used to reduce current NIIT?
Yes, this is an excellent mechanism to utilize prior losses to reduce your current NIT. If you have suspended passive losses from an activity from prior years, back when it was passive for you, but now it's become non-passive, meaning you now materially participate, these previously unusable losses are allowed as properly allocable deductions against your NIT.
How does that work?
They first offset any current year net investment income generated by that same activity. If there are any remaining suspended losses after that, they can then offset other net investment income from other passive activities that are included in your NII calculation.
So you get to free up those old losses against current NIIT.
You do, to the extent you have current NII from that activity or other passive NII. It can be a valuable tool for lowering your NIT in years where you have significant investment income and a history of those prior passive losses hanging around.
Now let's talk about gains and losses from selling property, found on lines 5A through 5PET. What's the general rule here? And more importantly, what are the key exclusions or strategies for reducing NIT in this area?
Okay, lines 5A to 5BETs deal with capital gains and losses. Generally, any net gain from the disposition of property not used in a trade or business, so your typical investment asset sales like stocks or bonds, and any net gain or loss from property held in a Section 1411 trade or business, like a passive activity or a trading business, is included in NII, assuming it's taken into account for your regular taxable income.
So investment gains are generally in?
Generally in. However, here's where the strategic exclusions come in, and they're important. Gains that are not taxable for regular income tax purposes, like the gain from the sale of your principal residence that's excluded under Section 121.
The home sale exclusion, right.
Exactly. Or gains deferred through like-kind exchanges under Section 131.
Yeah.
These are not included in NII. This is a crucial exclusion for homeowners and real estate investors.
That makes sense. If it's not regular income, it's not NIT income.
Precisely. Also, any gain or loss from the sale of property held in a non-Section 1411 trade or business, again, your active business that isn't primarily trading financial instruments, is generally excluded.
Like selling business equipment.
Right. If you sell a piece of equipment or a building that was genuinely used in your active manufacturing business, that gain might not be subject to NIT. It gets adjusted out. Also, net unrealized appreciation, or NUA, in employer securities distributed from a qualified plan is also excluded from NII, which is important for employees with company stock in their retirement plans.
NUA.
And for certain passive foreign investment companies treated as qualified electing funds, QEFs, if you haven't made that special Section 1.141110G election we talked about, any amount treated as long-term capital gain for regular income tax under specific rule for QEFs, Section 1293-WTA-1B, is not included in NII.
Lots of specific exclusions there.
Yes. These are all ways to carve out certain capital gains from the NIT. You need to carefully track the source and character of your gains.
You mentioned adjustments to capital loss carryforwards earlier. How do those work for NIIT purposes, and why is that important?
Yes, the capital loss carry-forward adjustment. Since 2014, there's a specific rule. If, in a prior year, the sum of all capital gain or loss amounts that were excluded from your net investment income resulted in a net loss, meaning your excluded capital loss were greater than your excluded capital gains.
Okay, you had a net excluded loss.
Right. then your capital loss carryforwards that you calculate for regular tax purposes must be adjusted downward for NIIT purposes in future years.
How much is it adjusted down?
You reduce your regular tax capital loss carryforward for NIH but a lesser the carryforward amount itself, or that excess excluded loss from the prior year.
Why do they do that?
It prevents a situation where a loss that already gave you a benefit by being excluded from NIE in a prior year could then improperly reduce NIAT again in a future year when carried forward. It's about maintaining consistency and preventing a double benefit.
Got it. Prevents gaming the system with excluded losses.
Essentially, yes.
Line 5C specifically deals with adjustments from the disposition of partnership interests or S corporation stock. This sounds highly technical, but potentially very important for business owners selling their stakes.
This is highly technical, but absolutely critical for business owners selling their business. Generally, when you sell a partnership interest or S corporation stock, the gain or loss is included in NII.
Why? Isn't that selling part of a business?
Because the stock or partnership interest itself is typically treated as property held for investment, not property held directly for use in the entity's active trade or business.
Yeah.
That's the general rule.
Okay, so the default is that the gain is NII.
Yes. However, here's the powerful adjustment on line 5C. If you materially participated in a non-trading Section 162 trade or business conducted by that entity.
So you were active in the underlying business.
Right. Then you must calculate a specific adjustment based on proposed IRS regulations, Section 1.14117. This adjustment reduces the gain included in NII.
How does it reduce it?
It effectively carves out the portion of your gain that's attributable to the appreciation of assets used in the entity's active non-trading business operations, assuming a hypothetical sale of those assets by the entity. It ensures that the part of your gain reflecting active business operations isn't unfairly hit by the NIIT.
That sounds complicated to calculate.
It is. It often requires information from the partnership or S-corp about the underlying assets and involves a multi-step calculation. And you are required to attach a detailed statement to your return.
What's in the statement?
It needs to spell out the entity's name and ID number, your gain or loss for regular tax, any relevant information you got from the entity, like special K-1 codes, and critically, how you calculated the adjustment amount. It's a key area where precise record-keeping and professional advice really pay off.
Definitely seems like a place to get help.
Absolutely. And this adjustment also applies to deferred recognition sales, like installment sales. So even if you sold the entry before 2013 when NII started, you still account for the NIT adjustment related to the active business portion as payments are received in 2013 or later.
Line 6 is where we address those complex foreign entities, controlled foreign corporations, CFCs, and passive foreign investment companies, PFICs. Why are specific adjustments needed here for NIIT?
CFCs and PFICs. They're complex because they have their own set of anti-deferral rules for regular income tax that force you to include income even if you don't receive cash. These rules also significantly impact NIIT.
So line 6 bridges the gap.
Essentially, yes. Line 6 is a dedicated space for specific adjustments when these types of foreign investments require amounts to be added or subtracted from your net investment income that aren't already reflected on other lines.
What kind of adjustments?
They vary depending on how the foreign income is treated for your regular income tax. For example, if you have a PFIC and use the mark-to-market election under Section 1296, meaning you treat gains and losses as if you sold the stock each year for regular tax, those mark-to-market inclusions and deductions generally get factored into NIT via Line 6.
Okay.
Similarly, certain excess distributions from PSEs taxed under the Section 1291 rules can be added to NII here. It's really about aligning the NIT treatment with these special foreign income inclusion regimes.
You previously mentioned a specific election for CFCs and QEF, Section 1.141110G. What's this election, and how does making this choice affect NIIT, potentially simplifying things?
Right, this is a truly important election, the Section 1.141110G election. It can definitely simplify how these complex foreign investments are treated for NIIT and potentially save you headaches and unexpected taxes later.
How does it work?
If you make this election for a CFC or a qualified electing fund, QEF, generally the amounts you're already including in your income for regular income tax purposes from these entities like Subpart F income from a CFC, GILTI from a CFC, or QEF inclusions are included in your net investment income on line 6.
Okay, so the regular tax inclusion becomes NII. What's the upside?
The huge upside comes later, when you actually receive distributions from that CFC or QEF that are treated as previously taxed income, PTI, for regular tax purposes, meaning you already paid regular tax on it when it was earned by the entity. Those PTI distributions are then excluded from NII.
Hmm. So you avoid paying NIT on the distribution if you paid it on the inclusion.
Exactly. This election effectively aligns the NIT timing with your regular income tax timing. It prevents that potential double taxation, paying NIT on the inclusion and again on the distribution, and it streamlines a very complex area.
That sounds like a good election to make, usually.
Often, yes, but it depends on individual circumstances. It applies to the specific stock you make it for, and any stock of that same entity you acquire later. It's generally irrevocable once made.
When do you have to make it?
Typically, it must be made on a timely filed return, including extensions. For the first tax year, you are subject to NIT, and you have a required income inclusion for regular tax from that specific CFC or QEF.
So you can't wait too long.
No, you need to be proactive. It's not a casual choice. You check the box for the 1.1401 10G election on Form 8960 and attach a statement with specific identifying information about the foreign entity and a declaration that you're making the election. Now, if you don't have this election in effect for a CFC or QEF, different, often more complicated, rules apply. This can sometimes mean that certain distributions of previously taxed income from the CFC or QEF that aren't subject to regular income tax are included in NII. Or it can lead to alternative basis calculations for your interest when determining gain or loss for NIT. These non-election situations can add layers of complexity and potential unexpected NIT, underscoring the importance of understanding this election's impact.
Line 7 is other modifications to investment income. This sounds like the catch-all for anything not explicitly covered elsewhere. What are the key deductions and reductions here that can lead to significant tax savings for listeners?
Line 7 is indeed the catch-all, but it's a vital one. It's used for any additions or modifications to your net investment income that aren't specified on lines 1 through 6. And yes, this is where some truly significant tax-saving opportunities can be found.
Like what? What's the big one here?
One of the most important is the net operating loss, NOL deduction, specifically adjusted for NIT purposes.
NOLs can reduce investment income tax.
Yes. If you have an NOL deduction allowable for regular income tax purposes, meaning your business losses in a prior year exceeded your income, you may also be allowed some or all of that NOL deduction against your net investment income on line 7.
How much of the NOL can you use?
You need to calculate an applicable portion of the NOL for each loss year that is specifically attributable to NII items. You essentially recalculate your NOL for that year, considering only NII-related income and deductions. The lesser of that NII-based NOL or your regular tax NOL for the year becomes the applicable portion that you can use to offset NII in carryover years.
So business losses can directly shield future investment income from NIT.
Correct. This is a significant planning tool for those with business losses. Carrying over these NIT-applicable NOL portions to offset future investment income can provide substantial NII relief.
Any limitations?
A key one. No portion of an NOL incurred in a tax year beginning before 2013 is allowed to reduce net investment income, as the NII effectively started in 2013. Calculating your NOL involves determining what portion of your overall NOL would have existed if you only considered NIT-related income and deductions. If that NIT-specific NOL calculation results in a loss that's less than your regular tax NOL for that year, then that smaller amount is your applicable portion to use against NOL. If the NIT-specific calculation results in a loss greater than or equal to your regular tax NOL, then 100% of your regular tax NOL is the applicable portion.
Okay, so you figure out the relevant part of the NOL.
Right. This applicable portion is then used as a negative adjustment on line 7 in the carryover year to reduce your current year's NII, even if you weren't actually subject to NIT back in the year the NOL originated. It's a powerful way to leverage prior business struggles into future NIA savings.
That's a great relief for business owners with past losses. What about deduction recoveries, like getting a refund for a state tax deduction you took previously? How does that affect NIT, and are there any exceptions that prevent double taxation?
Good question. Deduction recoveries, or refunds of items you previously deducted, generally increase your net investment income in the year you recover them. This goes on line 7 as a positive adjustment.
So a state tax refund could increase my NII.
It could, if the original state tax deduction reduced your NII in the prior year. This is the IRS's way of reversing a prior tax benefit.
But are there exceptions? It seems unfair if the deduction didn't even save me NIT before.
Exactly. There are crucial exceptions designed to prevent unfair double taxation or taxing amounts that didn't provide a NIT benefit in the first place.
What are they?
First, if the prior deduction didn't actually reduce your NIT liability in the year it was taken, maybe your MAGI was too low or you had no NII, then the recovery isn't included in NII when you get it back.
Okay, no prior benefit, no current inclusion.
Right. Second, if the recovered amount is already included in net investment income in the year of recovery for some other reason, meaning it's already being subjected to NIE elsewhere on the form, it won't be double counted on line 7.
Makes sense.
Third, if the deduction was taken in a tax year before 2013, before NII existed, the recovery is not included.
Okay, pre-NIT deductions don't count.
Correct. And finally, if the deduction was taken in a year after 2012 and you weren't subject to NIE solely because your MAGI was below the threshold in that prior year, unless you incurred an NOL that year, which had an NIE component, then the recovery is also generally not included.
So basically, if the deduction didn't save you NIT, the recovery won't cost you NIT.
That's the principle. It avoids the frustration of being taxed twice or taxed unfairly on a recovery, like receiving a state tax refund related to a previous investment deduction that gave you no NIT benefit. It's a subtle but vital point for fairness.
Are there any other notable adjustments or deductions that fall under this catch-all line 7 that our listeners should be aware of?
Yes, there are a few more points here that can make a difference. We mentioned self-charged interest earlier. If you received interest income from lending money to your own non-passive pass-through entity where you materially participate, that interest income can often be excluded from your NII here as a negative modification.
Right, the self-charged interest exclusion.
Also, other items on line 7 can include certain above-the-line deductions from page 1 of Form 1040, meaning those that reduce your gross income before you get to AGI, if they are properly allocable to generating income that is included in NII, like income from a passive activity or a trading business, but aren't captured elsewhere on Form 8960.
Okay.
Also, adjustments for distributions from estates and trusts, specifically amounts reported in Box 14, Code H, adjustment for Section 1411 net investment income of Schedule K1 from a trust or estate, are accounted for here on line 7.
Code H from the K1. Got it.
If you choose to make the election on Form 8814 to report a child's interest and dividends on your own return, those amounts are generally included on your line 7, though remember to exclude any Alaska Permanent Fund dividends portion.
Okay.
Finally, various other miscellaneous items might land here. Substitute interest and dividend payments you receive, net positive periodic payments from complex financial instruments called notional principal contracts, NPCs, if they're investment type, and even casualty and theft losses related to investment property or income-producing property that's not part of an active non-NIT business can be included as negative modifications on this line. It's truly the line for unique situations and final tweaks.
Investment expenses and deductions, Part 2 of Form 8960, reducing your NIT.
Now we're moving into Part 2 of Form 8960, which focuses on investment expenses and deductions. This is another crucial area where you can directly reduce your net investment income and consequently your NIT. What are the general principles for what's considered a properly allocable deduction?
Okay, Part 2. The whole point here is to allow you to reduce your gross investment income from Part 1 by deducting certain expenses that are directly connected or properly allocable to generating that income. These are often expenses that you might otherwise list as itemized deductions on your Schedule A.
So, investment-related expenses.
Exactly. A key principle here and a point of flexibility is the reasonable method allocations. If a deduction is partly tied to net investment income and partly tied to income that's excluded from NIT, think about state income taxes that cover both your investment earnings and your salary.
Right, that's common.
The IRS allows you to use any reasonable method to determine the portion of that deduction that is properly allocable to your NII.
Any reasonable method, like what?
Well, a common one is to allocate the deduction based on the ratio of your gross investment income from line 8 of Form 8960 to your total adjusted gross income. But other reasonable methods might exist depending on the facts.
So you have some leeway in how you allocate.
You do. This reasonable method allowance is a fantastic piece of flexibility the IRS provides. It means you can choose an allocation approach that makes the most sense for your specific financial situation each year, potentially maximizing your deduction against an II. But it's crucial to remember that only deductions specifically identified as properly allocable to NII in the IRS regulations or official guidance are permitted. You can't just deduct any expense you think might be related to investments. It has to meet the specific criteria outlined for NIIT purposes. This isn't a free-for-all, but it is a targeted opportunity to reduce the tax.
Let's go line by line through these deductions then. Line 9A is for investment interest expense.
Right, line 9A, this is where you'll enter your investment interest expense. For individuals, this typically comes from Form 4952, Investment Interest Expense Deduction, or maybe directly from Schedule A if you didn't need Form 4952.
Okay, interest paid on investment loans.
Exactly. Interest paid on money borrowed specifically to purchase or carry investments. Just be sure you're not double counting amounts that might have already been deducted against passive income elsewhere or amounts related to tax-exempt interest which isn't deductible. Also, remember those complex foreign entities, CFC-SQEFs. If you didn't make that Section 1.141110G election, there might be special rules for calculating your deductible investment interest expense for NIIT, possibly requiring an adjustment on line 6 instead of line 9A.
Another foreign complexity.
Always worth checking if you have those.
Line 9B covers state, local, and foreign income tax. How do these taxes apply to NIAT, and what's a critical caution here?
On line 9B, you'll include the portion of your state, local, and foreign income taxes that you paid and can reasonably attribute to your net investment income. As we just discussed, you can use any reasonable method to allocate these taxes.
Okay, allocate reasonably. What's the caution?
A very important one. You cannot deduct foreign income taxes here on line 9B if you chose to take a foreign tax credit for those same taxes on your main tax return. Form 1116. It's strictly one or the other, either a deduction against NII and potentially regular income via Schedule A, or a credit against your overall tax liability. You can't have both for the same foreign taxes.
Deduction versus credit. Pick one. Got it.
But the bigger point for most listeners, especially relevant right now, is about the limitations that usually apply to state and local taxes, the SALT cap, and other itemized deductions. The Tax Cuts and Jobs Act introduced major changes.
Right, the SALT cap and suspended miscellaneous deductions. How does that affect NIT deductions?
Well, the $10,000 SALT cap does limit the amount of state and local income or sales and property taxes you can deduct on Schedule A for regular tax. That limitation flows through here. The amount you deduct on line 9B for state and local income taxes attributable to NII cannot exceed the amount actually allowed as a deduction on your Schedule A after applying the SALT cap and any other relevant limitations.
So the SALT cap can limit your NIT deduction too.
It can, indirectly, yes, because your starting point is the deductible amount for regular tax. However, the other limitations, like the overall limitation on itemized deductions, P's limitation, and the 2% floor for miscellaneous itemized deductions, are suspended for tax years 2018 through 2025.
Ah, those are suspended.
Yes. So while the SALT cap is in effect, those other percentage-based limitations that used to phase out deductions for higher income individuals are temporarily gone. This might mean that more of your allowable state and local taxes, up to the SALT cap, and potentially other deductions are actually usable against NITT during these years. It's a complex interaction, but the suspension is generally helpful.
And line 9C is for miscellaneous investment expenses. Are these also impacted by that temporary suspension you just mentioned?
Yes, exactly the same principle applies regarding the suspension. On line 9C, you'll report expenses that are directly connected to the production of your investment income. Think investment advisory fees, safe deposit box rental fees if used for investments, maybe some legal or accounting fees directly related to your investment activities.
Okay, direct investment costs.
Right. These types of expenses fall under the category of miscellaneous itemized deductions subject to the 2% floor for regular tax purposes. However, as we just noted, that 2% floor limitation, along with the overall P's limitation, is suspended for tax years 2018 through 2025.
So you don't have to worry about the 2% floor for these right now.
Not for these years, no. This means that during the suspension period, you can potentially deduct the full amount of these qualifying miscellaneous investment expenses on line 9C as long as they're properly allocable to NII without them being reduced by that 2% of AGI floor. This makes line 9C potentially more valuable currently than it was before or will be after 2025, assuming the law doesn't change.
That's a significant temporary benefit.
It is. Just be careful not to include expenses you've already deducted elsewhere on your return, like investment interest, that's on 9A, state taxes on 9B, or expenses related to passive activities that might be accounted for elsewhere.
Finally, line 10, additional modifications. What other deductions or specific situations can our listeners claim here to reduce their NIT?
Line 10 is another catch-all, but this time for deductions or positive modifications that increase the deductions allowed against NII. It's for things not specifically listed on lines 9A, 9B, or 9C.
What kind of things end up here?
A significant deduction opportunity here involves a special rule for traders in financial instruments or commodities who have marked their status as a trader for tax purposes.
Active traders again.
Yes. If your only trade or business is actively trading financial instruments or commodities, you can deduct your ordinary and necessary business expenses from that trading activity, like what you'd report on Schedule C, directly here on line 10 as a positive number, increasing your total deductions.
So trading expenses can directly offset NII here.
They can, provided those expenses aren't already being used to reduce your self-employment income. Since income from a trading business is generally not subject to self-employment tax, the expenses usually aren't reducing SE income, making them available here to reduce NII. This can be a direct and substantial benefit for qualifying active traders.
What if they have another business besides trading?
Good question. If you have multiple trades or businesses, and at least one is trading, it gets more complex. You'll likely need to complete a specific worksheet found in the Form 8960 instructions to determine the deductible amount for line 10. The goal is to ensure you only deduct the portion of those trading expenses not already effectively utilized against self-employment income from other non-trading businesses you might operate.
So it prevents a double benefit with SE tax.
Exactly. Properly reporting these expenses for traders on line 10 can significantly lower their NIIT liability, so it's a key area for those actively in the trading business to understand. Other less common deductions might also end up here, like certain amortizable bond premiums related to taxable interest.
Calculating your NIT Part 3 of Form 8960.
We've covered the income, the exclusions, and all those strategic deductions in Parts 1 and 2. Now let's bring all these pieces together for the final calculation in Part 3 of Form 8960. Line 13 is your Modified Adjusted Gross Income, or MDI. What's important to remember here as we approach the final numbers?
Right, line 13 brings back MGI. As a quick recap, for most people, this will just be your adjusted gross income directly from your Form 1040 or 1040 SR, line 11.
Okay.
However, remember those specific adjustments we talked about way back at the beginning. If you exclude foreign earned income using Form 2555, or if you have certain income related to possessions or specific situations with CSPFICs, your AGI will need to be modified to arrive at MAGI. For most people with foreign earned income exclusion, you have to add that excluded amount back to your AGI to get your MAGI.
So MAGI is often AGI, but sometimes higher due to add-backs.
Correct. This MGI figure on line 13 is absolutely crucial because it directly determines if your overall income level is above the NIT threshold amount for your filing status. That comparison is the primary gateway to being subject to this tax at all. No MAGI over the threshold, no NIT.
And line 14 clearly shows the threshold based on your filing status. Let's quickly reiterate those specific dollar amounts.
Absolutely. These are the fixed dollar amounts, the NGI hurdles, that define whether you're potentially in the NIT zone, regardless of how much actual NII you have. It's $250,000 for married filing jointly or a qualifying surviving spouse.
Okay. $250K joint.
$125,000 for married filing separately.
$125K separate.
And $200,000 for single filers or heads of household.
$200K single heritage.
Don't forget that special rule for U.S. citizens or residents married to non-resident aliens, unless you make that specific Section 6013G or a KH election to file jointly for NIIT purposes, you'll default to the lower married filing separately threshold of $125,000 here. These are your income checkpoints.
So once we have our MGI from line 13 and the applicable threshold from line 14, how do we get to the final NIIT calculation for individuals on lines 15 through 17? This is the moment of truth.
Right. The final calculation for individuals is quite straightforward once you have your key numbers. Your total net investment income from line 12, which is Part I income minus Part 2 deductions, and your AGI excess over the threshold. First, on line 15, you subtract the threshold amount, line 14, from your AGI, line 13. This gives you the amount your income exceeds the threshold. If it's 0 or less, you stop. No NIT.
Okay, MGI minus threshold.
Then on line 16, you enter the smaller of two amounts. Your total net investment income from line 12, or the excess MGI over the threshold from line 15.
The lesser rule again.
Exactly. You're taxed on the lesser of your investment income, or how much your overall income exceeds the limit.
That makes sense.
Finally, line 17 is the tax itself. You multiply the amount on line 16, the smaller amount, by 3.8%, or 0.038. That result is your net investment income tax.
And where does that number go?
That final NIT amount from line 17 is then carried over to Schedule 2, Form 1040. Additional taxes, Part 2, line 12, where it's added to your overall tax liability for the year.
Okay, adds to your total tax bill. And for estates and trusts, how does their final NIT calculation work on lines 18 through 21? I know their thresholds are typically much lower.
For estates and trusts, the calculation follows a similar logic, but uses their specific figures and includes deductions for distributions. They start with their NII before distributions on line 18A. Then, line 18B is where they account for significant deductions that reduce their undistributed net investment income. This includes deductions for distributions of net investment income made to beneficiaries during the year, calculated based on specific allocation rules.
So distributions to beneficiaries reduce the trust's NII.
Correct, for NISH purposes. Line 18B also includes properly allocable charitable deductions claimed by the estate or trust. For specific trusts like electing small business trusts, ESPTs, the S corporation portion's net investment income can also be reduced by certain charitable deductions related to that S corp income. Subtracting these distributions and deductions gives you line 18C, the final undistributed net investment income for the trust or estate. This amount cannot be negative.
Okay, that's the NII base for the trust.
Right. Then separately, on line 19A, you enter the adjusted gross income, AGI, for the estate or trust, potentially with those CFC-PFIC adjustments if applicable. Line 19B then brings in the applicable threshold for estates and trusts. Remember, this threshold is very low. It's the dollar amount at which the highest tax bracket for estates and trusts begins for that specific tax year. It's published annually by the IRS, but is typically just over $15,000 these days.
Much lower than the individual thresholds.
Way lower. Line 19C calculates the excess of the trust's AGI over this low threshold. Finally, line 20 applies the lesser of rule. It takes the smaller of the undistributed NII, line 18C, or the excess AGI over the threshold, line 19C.
Same lesser of logic.
Exactly. And line 21 calculates the tax, 3.8% of the amount on line 20. This calculated NIT amount for an estate or trust is typically reported on its income tax return, Form 1041, Schedule G, line 5, or Form 1041 QFD, line 15, for qualified funeral trusts.
Wow. That was a truly deep dive into Form 8960. We've covered the core definitions, pinpointed which income streams are included, and more importantly, uncovered those crucial exclusions and those deductions. It's absolutely clear that understanding this form isn't just about ticking boxes. It's really about strategic financial planning and finding those powerful tax-saving opportunities.
Absolutely. The nuances in NIT, especially with, all the various types of investment income and the specific rules for businesses, real estate professionals, and even those complex foreign investments, mean that proactive record keeping and a clear understanding of your income sources are paramount.
Gotta know where your income comes from.
You really do. Remember, certain elections, like that Section 1.141110 Jmeer 1 for foreign investments, and careful income classifications, especially distinguishing active versus passive activities and identifying those non-Section 1411 trades or businesses, can make a significant difference to your bottom line tax liability.
And don't forget the deductions.
Definitely not. Utilizing properly allocable deductions like investment interest and the allocable portion of state taxes, and understanding how to leverage things like NIT/NLs and the rules for deduction recoveries are also key levers in your tax strategy.
So what does this all mean for you, the informed investor listening right now? The key takeaway here is that the NIT isn't just some flat tax on all investment income above a certain amount. It's way more nuanced than that. It has built-in exemptions, and it has strategic pathways for reduction.
That's the important part, the planning opportunities.
Right. Knowing what's excluded, like income from qualified retirement plans or your active non-trading business income, and what deductions you can legitimately take are your most powerful tools. This deep dive should give you a strong foundation to look at your investments and income streams with a new, more tax-savvy perspective, hopefully allowing you to potentially optimize your financial position and, well, keep more of your hard-earned money.
Indeed. It's really about being informed, taking control where you can, and understanding the rules of the game so you can play it intelligently, not just reactively when the tax bill comes.
So here's something to think about. Consider this. How might a strategic shift in your investment approach, perhaps focusing more on those NIT-exempt retirement accounts, or taking steps to ensure your active business income is properly classified and documented, or maybe even proactively working towards meeting those real estate professional safe harbor hours, how might that influence your overall wealth accumulation and financial freedom in the years to come? Food for thought.